At 4, all economic signs appear to point to interest rate relief ahead of the holiday spending season. Fed Chair Jerome Powell laid out his monetary policy forecast at the Kansas City Federal Reserve Summit in Jackson Hole, Wyoming today. While he stayed light on details, he did set the stage for a long-awaited September rollback.
The time has come for policy to adjust.
It's the Fed's clearest signal yet that rate relief is on the way.
The timing and pace of rate cuts will depend on incoming data.
That magic word, cuts, which most economists expect will begin next month. But just how deep, still unknown.
With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation.
That dialing back has been a long time coming. The Fed started aggressively hiking rates in early 2022, reaching a 23-year high to combat the highest inflation in decades as the world tried to recover from a global pandemic. The economy has been growing, but consumers are still feeling squeezed by the high cost of credit, mortgages, groceries, and other loans.
With prices having risen 2.5% over the past 12 months, progress toward our 2% objective has resumed.
The Fed's favorite inflation gauge, the Personal Consumption Expenditures Price Index, showed an annual rate of 2.5% in June, down from just over 7% 2 years ago.
The labor market has cooled considerably from its formerly overheated state.
A cooling amplified this week after the Labor Department shaved 818,000 jobs off a 12-month total ending in March. That, plus the current unemployment rate, highest since the fall of 2021, has many Fed watchers anticipating an even bigger rate cut than what may have been planned. The Fed's next policy meeting is in mid-September. And Wall Street is taking the Fed chair's announcement well, you might say. The Dow up 462 points, solidly in the green. The Nasdaq up 258 points, and the S&P 500 up just about 63 points.